Welcome to our Taking Stock video for the week ending the 21st of April 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Great to have you here, Matt, and it'll be interesting to hear your views on the US market, especially with the first quarter reporting season in full swing.
No, absolutely. We'll get to that, Cam, but it's great to be joining you.
Yes, but before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented here today shouldn't be relied upon as a guide for future performance. Well, Matt, after a strong rally over the past few weeks, the Australian market has taken a breather as investors assess whether the recent market optimism is warranted. Here in Australia, commodity prices and our resource stocks have been supported by better than expected China first quarter GDP growth numbers, which rose by an annual rate of 4.5%. And that was driven by consumer spending and also higher factory activity. Our star resource stocks, they are releasing their quarterlies and we'll be providing an overview of our findings next week.
And moving across the Pacific, as you alluded to before, the US first quarter reporting season has kicked off with a fairly solid start. So the majority of companies have reported better than expected figures so far, but we are very early into the period and there has been some notable weaker than expected results, such as Tesla, who reported Thursday morning. But more pleasingly, despite the global banking turmoil emerging last month, the systemically important US banks like JP Morgan, Citigroup, Wells Fargo, Morgan Stanley, and Bank of America all reported profits that beat expectations. And these solid results seem a bit counterintuitive, don't they? But consumers had been moving away from the smaller regional banks after the Silicon Valley collapse, and the beneficiaries of that deposit flow have been those larger banks. So from an investing standpoint, it makes sense for investors to focus on these high quality businesses in the current environment.
Yeah, that makes so much sense, Matt. With rising interest rates and slower economic growth, there are significant risks by investing in those financially weak businesses. In fact, data released from the corporate regulator this week showed that 831 companies appointed administrators last month, and this compares to around only 700 in the financial years preceding COVID. Many high-risk sectors lie in construction, hospitality, retail, and also manufacturing. And for example, we had beauty and skincare retailer BWX. They were the owner of popular brand Souk, and they recently went bankrupt, didn't they?
We're going to be accused of sounding like broken records at times, Ken, aren't we? But we can't reiterate enough that the shifting economic cycles are likely going to expose these financially weak companies. So, for example, casino operator Star Entertainment Group has downgraded its earnings guidance again and undertaken a round of cost cuts. And automotive crash repair business AMA Group warned of margin pressures from higher costs and labour shortages. Meanwhile, gold miner Regis Resources downgraded its full-year production guidance on the back of operational problems, rising costs and wet weather events.
Yeah, quite a busy week of announcements, Matt, but these financially unhealthy businesses are facing significant challenges. But let's now turn our attention to some Star stock highlights over the week. We had Star Growth Stock and Star Income Stock Challenger. They reaffirmed their financial year 23 net profit guidance, forecasting an 8% rise in earnings for the year. However, the market reacted negatively to its third quarter trading update due to softer sales from its institutional life business.
Yeah, very true. That did, unfortunately, Cam, but we're not overly concerned by it, given that there is strong growth across Japan and retail life sales, which are high margin divisions. So the business is benefiting from rising interest rates, which has made the yield on its annuity products more attractive to the retail market. So this should support the group's earnings growth forecast at 13% and sustain its gross dividend yield of about 5.7%.
Right, and speaking about interest rate beneficiaries, earlier this week, wealth platform operator HUB24, they released their third quarter update, which revealed a 16.5% lift in its platforms under administration to 59 billion. And this growth was driven by positive market performance, together with net fund inflows of around 1.9 billion. Like its peer Netwealth, HUB did report net fund inflows for the quarter, which was down by about 30%, and that was due to heightened market volatility over the last 6 to 12 months. However, this begs the question, Matt, why did HUB's share price still react positively on the day, which was up around 2 to 3%, while net wealth was heavily punished? They were down about 12% after its update last week.
Yeah, great question, Kien, and I'm still scratching my head over it. But maybe one of the key differences is that Netwealth provides a little bit more transparency with respect to its new flow guidance in FY23, and this did miss expectations. And HUB only provided total funds under administration target for FY24. And in addition to that, HUB recently won a contract with Equity Trustees. So this should lead to an additional $4 billion in funds under administration over the next 18 months. Roughly contributing to about 10 million to revenue as well.
Right, but regardless of the slowdown in net inflows, we believe the main contribution to earnings revenue really for both HUB and net wealth will be driven by the market direction and the optimism, and also cash management fees generated on client cash balances, which have benefited from rising interest rates. And this is really what drives the strong earnings growth for these stocks in the year ahead. Now, onto a company which tends to be a bellwether for the global economy is pallet and logistics giant and borderline-style growth stock, Brambles. They announced a pretty upbeat first quarter 23 result on Thursday, with sales up 15% on constant currency terms. But the company also lifted its full-year guidance by around 3%, Matt.
Another solid result from Brambles. And although we are in the midst of a softer economic conditions, and it did temper demand for supply chain logistics services, the company benefited from significant price rises and lower than expected costs around pallet destocking. This should lead to a slight increase in consensus forecast estimates moving forward.
Yeah, these high-quality businesses, they are able to increase their prices without not so much affecting the volumes. But for members who are curious on what pallet destocking means, many retailers, they held on to more shipping pallets during the pandemic, and that was to ensure they had enough inventory levels to prevent supply shortages. But with COVID over, those companies are returning the pallets to Brambles, and this means that they can reduce operational costs by not having to make more. So hopefully that makes a bit more sense.
And turning our attention to the week ahead, we have a number of mining and energy companies announcing quarterlies next week. Meanwhile, Woodside will be hosting their AGM on the 28th of April.
And for Under the Microscope this week, we take a look at star income stock, Bank of Queensland, which released its first half result this week. And this follows from their update last week, where they did pre-guide for first half cash earnings to be down by about 4%. And as a result, they ended up cutting their first half dividend to 20 cents per share from 22 cents per share last year, Matt.
Yeah, that did slightly disappointing, isn't it, Kane? But the bank has lifted its non-financial risk provision balance on the back of a regulatory risk assessment. So this assessment was specifically targeting Bank of Queensland cybersecurity and anti-money laundering risks. And given BOQ's franchise model and its outsourcing of IT cybersecurity services. So for members that may not be familiar, dividends are usually based on a payout ratio which is in proportion to their underlying earnings. And given this provision, that's meant that the underlying earnings were lower, which subsequently means that the dividend is lower than the previous period.
Right, Matt. But positively, these provision charges, they appear once off in nature, with the market pricing in a recovery in dividends over financial year 24. And following the update, consensus has revised their financial year 23 earnings and dividends estimates lower, bringing the total financial year 23 dividend to 45 cents per share. And that's translating to a gross dividend yield of roughly 10% on a 63% payout ratio.
And on top of this, Kien, as you alluded to before, BOQ did announce this $200 million goodwill write-down for Home Building Society. And this business was acquired back in 2007. So this isn't a huge concern to us. It just merely reflects the use of higher discount rates due to the rising interest rate environment, which subsequently means that the goodwill value needed to be written off.
Right, that makes sense, Matt. But I also noticed that the short interest in Bank of Queensland has risen to over 5%. And these short bets does reflect the heightened risk facing regional banks right now, including having a lower credit rating and higher funding costs, due to the rising rate environment. In addition, the bank does face significant risks associated with its integration of ME Bank, not to mention the risks you mentioned of sanctions from compliance and money laundering issues. We are currently re-evaluating these risks to determine whether the stock can be retained in our Star Income stock universe.
Yeah, there's a fair bit to digest there, Ken. So we'll certainly be looking for that note and update from Ryan. Note that the major banks are also reporting their earnings next month, NAB, ANZ and Westpac. So it will be interesting to see whether these banks are able to sustain their dividends. So for Bank of Queensland, for those that are long, they go ex-dividend on the 10th of May.
With the resources quarterlies in full swing, a useful question this week is, how can members compare the price trends of stocks, commodities, and their portfolios? Now, along with the whole suite of tools, Stock Doctor has an advanced charting section that allows members to apply technical indicators to stocks and also compare stock price histories to commodities, indices, and even fundamentals. For example, let's look at a small tier gold miner and star growth stock, Alkane Resources. They recently provided a quarterly update. Now we can easily overlay the stock price with the movement of gold to see if there's any correlation between the two. To do this, first navigate to the advanced charting under the tools dropdown.
And to allow for ease of use, the charting tools offer various chart types, including line charts, bar charts, candlestick charts, and more. This helps visualize price movements and trends. The easiest one to use is obviously just the line chart. So let's select this. Then type in the company code, which is ALK for Alkane Resources. And next, click on that compare button with the blue cross. And then you can click or navigate over to commodities as an option, where there will be another drop-down box and you can compare this with the US dollar gold price. You can also use this compare function on for multiple comparison points. So again, click on the compare button and you can also overlay both gold, the Alkane price chart, and also maybe the All Ordinaries Index for another comparison point.
Yeah, that's quite a powerful tool there. But another nifty feature is the left-hand tool panel. And this can be expanded by clicking on the top arrow here. Members can drill into stocks here, such as watch list and sectors, and even Lincoln funds and star stock portfolios. The events tab is quite interesting because it allows you to toggle options such as price sensitive announcements and ex-dividend dates. And this is useful for those who want to understand the price history of a stock on the day of these events.
And lastly, clicking on the full screen feature expands the charts, allowing you more room to conduct your analysis. And of course, there are other useful functions available, including drawing and annotation tools, technical indicators, and you can also take screenshots. You can click on the video tab to find out more, or otherwise feel free to contact our friendly client servicing team.
Well, Matt, that's all we have time for today. But again, thanks for that insightful discussion.
Always a pleasure to be joining you, Cam.
And I also understand that our office will be closed on Tuesday for Anzac Day. But if you have any questions regarding this episode or any questions on stocks or the markets, please come along to our Lincoln Live webinar on Monday, where, of course, you'll be there, Matt, and also our technical expert, Rob Manfrey, and myself will be available for a chat. Now, to summarize today's episode, the current economic environment, it remains quite challenging for those financially weak businesses, with quite a few of them releasing earnings downgrades over the week. But we've got to stick to those high-quality names to help you navigate this environment. Take care and have a happy, healthy, and prosperous week, everyone.